Hello there. Welcome everybody to our inaugural monthly investor call here as Prospera Energy continues our role here of increased transparency and getting information out to the market, beginning with this 2026 inaugural investor call. On the call here, we have myself, Chairman of the Board and CEO at Prospera Energy. We have Chris Lutke, Chief Financial Officer at Prospera Energy. And we have Sean Mailer, Investor Relations, as well on the call, who will be assisting us. This call is being recorded here live on Zoom and is also on Twitter Spaces on an audio-only version. For anybody on the Twitter call here that would like to join for the PowerPoint version here, please go to our monthly operations update that got put out on Monday morning, and there's a Zoom link in there which you can use to join us here for the slides version as well. The recording will be available here after the fact, the Zoom recording on YouTube, and then the Twitter Spaces records itself. So that'll be available as well. We'll have a brief presentation here about operationals update, key wells report. We'll be talking about some financial metrics and the go-forward business strategy of 2026, along with the 2025 look back of key learnings and key growth that we've had. Sean will be taking questions after the end of this presentation part of today's meeting and go from there. These will be held monthly. The full calendar will be available on the website shortly. We believe that the oil and gas side of our business, and in general, the oil and gas industry needs to do a better job at sharing what we do, how we're doing things, some of the engineering and technical pieces, and then, of course, the financial pieces as well. Our corporate deck and our key wells report has also been updated on the website, available for all investors to download, as well as the news release that got put out on Monday morning, which is a much more detailed version of our operations update that'll be put out here every month. Going forward, we plan to enhance this even further by adding certain macro graphs on the oil space in general and other technical information on some of the chops and water floods that we're doing. So looking forward to share here as we go. I want to remind investors that this is a forward-looking presentation. We will be discussing things about the 2026 business plan that are yet to happen. It is our expectation that we are moving forward under this scenario and that the actual results could differ materially depending on commodity pricing, well results, capital availability, and various other general world things that could happen. As far as our agenda today, we will be discussing the executive summary and investment thesis. We'll be talking about our currently open private placement that was launched on Monday, January 19th there, and the use of proceeds. Talk about our asset overview, especially our core Saskatchewan assets that are at the forefront of our strategy. We'll talk about a 2025 look back on the infrastructure and some of the production readiness, talk about the production performance, and get into the 26 production and capital plans as well. The field cash flow, free funds flow, want to show it from a more financial standpoint, the investor returns and the value creation as we go executing our base strategy, and then get into the long and strong commodity bull cycle here of a conclusion and next steps, followed by the aforementioned Q&A session as well. So the executive summary, we want to start off right from the 50,000-foot level and talk about what's working. The strategy is working. Our strategy and our main mantra here is legacy fields and modern solutions. These fields have been laying undercapitalized, underloved, under-engineered for many, many, many years, in some cases decades. We're coming in with a fresh strategy. It took us the last 12 to 14 months to prove out that strategy, and that strategy is now working. It's execution based. We're focused on low risk reactivations and optimizations across our Saskatchewan heavy oil assets. So we're not exploring, we're not shooting 3D seismic, we're not looking to do testing, coring, well logs. We have all of that in place with 40-acre well spacing, vertical wells on our loose land pool, and then the 2 water floods in Harts Hill and Cuthbert as well. There are multiple 3D seismic shoots already in place. There is a plethora of well control here. We have incredible production data, over 40 years of history. We have workover reports, and we have lots of information here already. All we're doing is going back in and bringing these wells back online. We have to accelerate the strategy here based on the results of 2025. We are currently in this $3 million equity raise. This will be deployed into high return workovers and further reactivations, and we'll discuss this here as we go. There's about a 250 barrels per day incremental production that we expect to add from this raise. We'll share more about the use of proceeds, how we do it, and what impact it has on the finances here as the presentation continues. And we're talking about near-term cash flow inflection from a 2025 break even, where we covered the corporate costs, we covered our operating costs, we covered G&A, we covered interest, and basically broke even, but proved out strategy and added barrels. We're now moving into 2026, where we're increasing our incremental cash flow with further acceleration of capital. Our field level cash on cash returns on what we would call a half cycle basis are 100% within that 12-month payback period on these projects. We've now got the 2025 reactivations to show that. I'll be talking about some of the wells and the well by well analysis here as we go. One of the things I do want to mention is as we grow the corporation, we don't expect to add any G&A at all. It's the same software, it's the same office space, it's the same group of employees that can run a company much bigger here. At current state, the wells need babysitting, they need constant monitoring. As we add additional wells, we understand the legacy wells way more, and so they require a little bit less of our time, and we focus more on the new wells coming online. There's no drilling required. There's absolutely zero drilling, exploration, any type of high-risk frac operations. It's redevelopment of the existing asset pool through sand cleanouts, bailing jobs, pump changes, tubing repairs, basic operations that are done hundreds of times a day across the Western Canadian Basin. And we have 140 reactivation opportunities in our inventory. And the 2025 operational reset has been completed. What took a lot of capital in 2025, what took a lot of time, what took a lot of effort was that these assets had been undercapitalized. They'd been undermaintained, underloved. We had to go in, fix injection pumps, we had to fix roads, we had to add insulation across the asset base. We had to go understand the pool a bit more. We had to solidify our fuel gas strategy to run these wells. We had to build relationships with landowners and vendors that we very much enjoyed. And that takes time. This is the real world. It's not a video game. It takes time to build these relationships. It takes time in the field. It takes time getting work done, and getting this operational reset completed. Stabilize our base production. There's more confidence in the capital we're going to put into the ground. We've restored the infrastructure integrity that gives us confidence in our cash flow modeling, and we've reduced the risk. We have reduced the gas issue. We've reduced H2S issues. We've added safety to the team. We've added further structures and governance around the field and the office, and just reduced risk of operational issues and incidents happening, which leads us to our free funds flow inflection. This current $3 million equity raise gets the barrels online that then allows the company to self-fund our growth from there onwards. So the cash flows at that point and the free cash flows at that point are high enough that we're able to either continue on this self-funded growth strategy or get into a net debt reduction strategy, which obviously reduces the balance sheet risk on the corporation and just allows us to continue to grow. It also gives us more access to capital. So by getting to higher levels, of production, getting to higher levels of revenue, cash flow, free cash flow, we have access to that additional capital availability as need be. And resilient equity returns. We've made the business resilient at $60 WTI. We were field cash flow positive at December $58 WTI average. And so we've shown now that the business can reduce cost. We've added efficiency. We've added just reduction of overall operating cost, some of which have been shared in our LinkedIn micro content. So for investors who are new to the story, and on our LinkedIn Prospera page, we share micro content, 2 to 3 minute long content about our strategy, sharing about key changes we've made, key operational efficiencies and strategies. I will recommend all investors have a look at that to get a further understanding of the corporation strategy here going forward. And we got exceptional upside to higher prices. So because of the fixed cost of the organization, because of the fact that we got a large asset base, we maintain an exceptional upside to higher prices. And we'll show some of that in actual modeling here as the presentation continues, which brings us to our mission sort of conclusion statement. The value add here is driven by execution, not speculation. And that execution has been proven over the last 14 months of work that our engineering and, more importantly, our field operations team has done, proving that out. Bit of an overview on the private placement. It's a $3 million non-brokered offering at 3.5 cents a unit. We have a target close date of February 15th, 2026. And each of these units will consist of one share of the company, common share, which trades on the TSX Venture under PEI, and one common share purchase warrant. The warrant is exercisable for a period of 2 years at 5 cents. Use of funds, $1,500,000 will be going to loose land reactivations and optimizations. This is by far our most successful proving out of strategy over the last year and a bit. We've 4x'd the field production here. I'll be sharing some details here as we go. And not only do we want to go and reactivate further wells out of our inventory of tier 1 reactivations, we want to optimize some of the current wells. So based on the learnings of the last 14 months, based on the learnings of how the wells are responding, there's additional barrels we think we can get out of the current pool and the wells that are operating by performing small cleanouts and pump changes on those. There's about $500,000 reserved for the Cuthbert workover program. Cuthbert also I will talk about here as the presentation continues and share some information. As some of you may know, we completed our Cuthbert pipeline project in mid-November, starting to see exceptional results from that. These are waterflood pools in Cuthbert. It takes time for that result to show. You inject water, the pool pressurizes up, it starts pushing the oil with it, and we're starting to show some really good production numbers out of that pool. And then $1 million of working capital. We think that we can make exceptional deals here with some of our vendors on the forward-looking capital program. And I think just having overall cash in the books allows the company to focus on some higher impact initiatives, such as some of the things that I'll discuss about here as the presentation continues. And the result is 250 barrels per day of incremental oil production and a $2.5 million increase to the 2026 annual field cash flow that compounds over time. These loose land wells some of them have 20 to 40 years of production history. There's other wells right next to them that have 2 years of production history with the same well log, with the same log signature, with the same original oil in place. We think there's a 20 to 40 year life here on some of those reactivations and also on some of the wells that have already produced for that long, because they are producing now at some very stable rates without showing any declines, without showing any sort of large drop in pressure as we go. Bit of our asset overview for investors that are new to the story. We have loose land, our reactivation and optimization engine. We are reactivating wells here that have been down for over 20 years. We've completed 18 of such projects over the last 14 months, and we have another 41 tier 1 projects here to go, along with optimizations on the current wells. As I talked about, Cuthbert, about 400 barrels a day of reliable cash flow generation, low royalties, low operating cost, large infrastructure in place. We simply just produce out of this. We track the wells on a daily basis, make injection changes as need be, and just continue to produce out of this pool. Harts Hill and Brooks are embedded optionality. These pools produce at their stable levels. We have additional, little bit higher risk projects to do here. Some water flood changes, some recompletions of wells. We're not going to go there. Those projects are going to get pushed to later this year or 2027 and beyond. We're going to focus on where we know we're going to get bang for our buck. But it's good to have embedded optionality in some of your other assets. No drilling. I keep repeating this. We are not interested in drilling any wells. We want to focus on our reactivation strategy and optimization strategy that's working exceptionally and requires less capital. We do reactivations for $150,000 each. We can do a sand cleanout and tubing bale and pump upsize for $27,000 each. These are smaller dollar costs. We can really decide when we want to put capital in the ground as opposed to get stuck with a 6, 7, 8, 10 well drilling program, massive capital requirement, inability to slow down. You're kind of just moving with the river there. 140 reactivation opportunities as well in our inventory. So 41 tier 1 reactivations in loose land. We have additional reactivation in loose land, a little bit higher water cut. And we have additional wells in Cuthbert and Hartsill that we can bring online and significant reserves in place. We're not talking about a thin 1 meter streak pay. We're talking 14 meters, up to 14 meters, 40% porosity, 2 Darcy rock, permeabilities that are competing with the Gulf of Mexico type of reservoirs, and about a 3 to 8% recovery factor here. So very, very strong reservoirs here. The core strategy of Prospera is to focus on these long life, low decline assets. And as I'll share here, some of the assets are anti-decline. The wells are going up as we clean up the perfs, as we clean up the reservoir, and as we continue to produce that oil from there. I do want to do a quick review here with the Twitter folks here that are on the call. If anybody would like to join for these slides, the conference call link for Zoom is on our Monday news release, and you can join us for the slides as well on there. Otherwise, please continue listening on the Twitter Spaces here. So here's a bit of our look back. So I'll move this here. You can see here the top graph is loose land. We have production increase. We have reliability increase. We're proving out our strategy of stable barrels from these legacy wells. From 10 cubes a day in November 2024, 63 barrels per day, to reliably 40 cubes a day, about 250 barrels a day for the last 3 or 4 months. We haven't spent any capital on reactivations since about August. So you can see how we're keeping the field exceptionally steady. We're not spending money on sand cleanouts. We're just keeping the pool steady and keeping our chugging here. We expect this to continue to rise without capital put in, with capital put in, another growth profile like this going forward. This graph gives us confidence in allocating further capital into these pools. We've already identified further reactivation efficiencies. So initially we were doing them a certain way. We were doing X amount of bailing runs. We were putting in a certain kind of pump. We've now changed that up. Now we're putting in bigger pumps. We're scanning every piece of tubing that comes out. We're moved into a more chops auger style pump that's going in these wells. Our speed up strategies have changed. So continual learning, which just leads to further efficiency as we go, and reduced operating cost. By really focusing on these well by well, we know which wells need more monitoring, which wells need less monitoring, which ones are going to potentially sand in on us and need a well load. Really dialed in strategy there. The bottom graph here is Cuthbert. You can see here, last winter we were constantly fighting this reliability issue with only a few days of high production, which is mostly flush production that came on after a shutdown. We then, over the summertime, spent time understanding the pool, really focusing on reliability. In late summer, we shut down for some infrastructure upgrades at the battery, including the injection pumps. You can see here in early October to about mid-October, we shut down again for the Cuthbert pipeline project replacements. And now this steadily increasing production, way more reliable, above 60 cubes a day, and just proper cash flow. We've increased the voltage coming into site. We've added insulation. We've gone and rebuilt certain engines that were not working. We've gone and rebuilt the shafts over the engines to make sure they run. We've added oil tanks. We've added reliability to our fuel gas supply. We've got extra spare parts on site. It's still a work in progress, but we've come a long, long, long ways. And we're excited to see this Cuthbert pipeline replacement project continue to add barrels to the water flood over the next 30, 60, 90 days. I want to remind investors that this is not just a flick on, flick off type of situation. When you put injection into water flood that hasn't been online for a period of time, it takes time for that void to pressure up and then push the oil with it as you go. Investors will be happy to hear that we will be updating these graphs very regularly on our key wells report and corporate deck going forward, so that you're aware of how that pool is responding over time, along with, of course, these monthly conference calls where more in-depth information can be provided. We'll have our personal information here and our corporate emails at the end of the presentation for any investors that want to either get a better understanding of the financial aspect of the company, learn more about the private placement, or chat about these engineering and production of these wells. Why are the strategies working? So let's get down to the actual data. Why are we so happy? Why do we think the strategy is working? Well, here's 3 wells in Luseland. The 16-07 star well. This produced in early August. We brought it online after it was down for over 20 years. It produced at a very high water cut for a period of time. We figured out the problem was over those 20 years, water had came in and filled the wormhole from where we'd produced the oil in the past. After about 10,000 barrels of water production that got produced, along with some oil, we now have started to see the rise. This is now our top well. It's making 32 barrels a day, consistent. There's still room for optimization. We're not going to push it too hard. We're going to stay at the 32 barrels per day and just continue to generate really good cash flow, really good revenue on a monthly basis out of this well. But you can see it's not reactivation day 1, day 2, you're swimming in money. It's a consistent effort to keep the well online, keep the sand moving up through the pump, up the wellbore, and into surface. Constant fluid shots, constant wellhead cut samples, day by day monitoring. And here we are after about a 5 to 6 month production period. Second well, 4 of 33. Section 33 is a section where there's only about 2 to 3% recovery factor, which means we have a lot more sand to produce. This well came on very, very strong. It produced fantastically for a period of about 3 months. We saw exceptional reservoir inflow, and then bam, it sanded in. So this time around, we're going slower. We're gonna just let her produce. It produced for 2 or 3 barrels per day for a period of almost 90 days. And I had people internally, we had some of the investors questioning, why are you not pushing this well? Well, because we don't want it to sand in. We don't want to spend money on workovers. So through that patience, through that financial discipline, we now have it making 10 barrels per day and will continue to rise. We've got a large portion of the near wellbore cleaned up with that sand brought up to surface, meaning if now we have a big gush of sand influx, you don't already have sand there and then it piles up your pump. Now the reservoir's got room to breathe. It's got ability to take some sand slugs and slowly bring them up the wellbore without the well sanding in. It requires patience, it requires focus, and it requires consistent day-to-day monitoring on these wells. Torque, fluid level, wellhead cuts, sand cuts, RPMs, daily monitoring. The 10 of 8 on the bottom here. This is a fantastic growth well. We've only had to speed it up a couple of times here, but do continue speeding it over time. And the oil cuts are rising. This is what we're finding on certain wells, is as they start to produce more and more and more, as that sand unclogs the perfs and we produce it up the wellbore, this oil can flow a lot easier. So it ends up coming into the wellbore a lot more versus just water channeling through a tiny little pinhole with some oil with it. So this well started off about a 70% water cut, 30% oil cut. It's currently about a 48% oil cut, 52% water cut. We expect that to continue down that route as we go. 3 more wells here, the 10 of 7 on top, steady Eddie, producing steadily at about that 20 to 30 barrels per day. We have slowed it down here recently as some of the water cut was starting to show up a bit more. We'll continue to monitoring this on a daily basis. It's flow line to our battery, so we don't need to truck anything. It's very low cost for us to push this well harder. 3 of 9, this well, consistent 15 to 20 barrels a day. We now have it making 20 barrels per day steady and speeding it up about 5 RPM every week. So we're not going to get rammy. We have lots of fluid level. We have solid sand coming up the wellbore. We got steady production profile, but we're not going to go rammy. We're going to do 5 RPM, watch it, and just see how the pump responds. Is the sand cut going up? Does the torque change? And does the water cut change? And if everything's steady, if we're seeing the pump efficiency the same, okay, let's add another 5 RPM. Okay, this week we don't want to add 5 RPM. We're just going to wait. Why? Just because we want to, and we don't want the well to sand in. So we're not trying to just maximize the barrels for a short period of time and then walk away like a shale company. We're trying to develop these wells for 20, 30, 40 years and prove out these strategies. On the bottom, 7 of 33 well. Again, section 33, massive sand. This well produced properly, consistently for about 5 months. This well has a recycle pump on it, so we're injecting 4 cubes of hot oil down the casing every day. That dilutes our sand cut and brings more sand up rather than it piling up downhole. And you can see for the past 60 days, we've been consistently bringing sand up the wellbore through these massive sand influx that's starting to come in. It's bringing production down certain days, but the well hasn't sanded in. We haven't had to spend 27, 30, 40,000 potentially on a workover. We've just kept it running. We've been able to bring that sand through the downhole pump up the wellbore, stinging this tank constantly because the sand is ending up in our single well battery tank. Day to day focus and monitoring required here. One of the reasons people walked away from this in the past because the wells kept sanding in. They couldn't keep the well running, and eventually your net back doesn't matter because you're spending so much on workover cost. Well, we haven't been on this well in 7 months, 8 months now. And that leads us to profitability. All of this is great, but what are the wells actually making? So you can see here our top 10 wells. October net operating income, $122,000 after royalties, after transportation, after operating cost, after all fixed cost. November, 144,000. December, with a little bit lower WTI, 93,000. So really starting to see these wells consistently chug out positive field operating cash flow. 359,000 from just our top 10 wells over the last 3 months. And I remind you, each of these reactivations is only about 150,000, including full surface setup, new tank setup, putting in a new engine, flow lines, berm, containment, drive, wellhead. About 150,000. You run these numbers, you can see how the paybacks start to really accelerate here as these wells get to higher and higher barrels. Reminding again investors that not all these wells were producing at the rates they are today, even in October. So this number is expected to continue to go up as we go here. The key takeaway, these wells represent and demonstrate that a small amount of reactivation capital can generate material, repeatable cash flow in a matter of months, and that continues month after month after month as we keep these wells rolling. So 2025 look back. A disciplined operating model has been implemented. We've got a material risk in health, safety, and compliance issues. We've been working with the MER in Saskatchewan, the regulatory body. We've been working with the Sask Power key senior leadership. We've been working with the RM, rural municipalities directly. We're working with landowners. Myself or my chief operating officer are in the field once every 3 weeks. We're going and meeting with the energy minister of Saskatchewan in February. So we're batting well above what our size would show. We want to come in here, demonstrate our strategy, and build a long-lasting, heavy oil reactivation co type of model for many, many years to come. Our infrastructure integrity and reliability has been restored. Spent a lot of time on this, a lot of headache, a lot of messages at 3 a.m. saying there's an engine down or something like that. We've got that fixed. We've increased our uptime. So by restoring this reliability, our uptime has gone up substantially, and we continue to add to that as time goes on. And we're a lean, fit for purpose organization. Our G&A is down. Our G&A is down by about 35% since the new management and board came in on October 31st, 2024. We continue to work at lowering G&A through software cost, office cost, making sure we keep all our costs in check. The same team today can run an organization much bigger as we continue to add wells and we continue to learn these wells. And our foundation has been established. We spent 2025 being reactive, fixing up the organization, corporately, field, office, strategies, infrastructure. We spent all that time, money, effort, blood, sweat, and tears. We're now set up for sustainable growth in a much more efficient manner. For every dollar that comes in today is an order of magnitude more efficient than what came in a year earlier when we didn't have our strategy down. We were still learning. We were still trying to understand how to get the company back on track. And that's exactly our key takeaway here. And I'll pass it over to Chris, our CFO now, to continue with the presentation. A small reminder, anybody on Twitter Spaces that would like to join for the Zoom PowerPoint, please go to our Monday news release, and there's a Zoom link in there to join us if you would like to come into the video portion of the presentation as well. Chris?
Thanks, Shubham. Excellent and exciting, and I'm actually proud to be part of this team here, having been with the organization for a longer period of time through the management transition in 2024. And I think the state where the company's at really currently is a testament to the hard work that you yourself put in and the rest of the team. And so big thanks to all of that hard work that's gone into the business and is effectively why we're in the situation where we can actually start to move things forward, grow the cash flow, and start to increase the production of the business. The slide, if you want to just go back one slide, Shubham, should be the production and cash flow slide, which is should be the one prior there. Yep, there you go. So this slide is essentially a reflection of the production growth as a result of the capital being deployed that's associated with this private placement. The base production reflects stable, low decline legacy assets. These provide a reliable foundation with predictable operating performance, utilizing that existing improved infrastructure with operating teams already familiar and in place. These base volumes essentially sustain the operations while the growth capital is going to be deployed this year. And the key message is really that the base business is stable and de-risked. The added production is really incremental production that's driven entirely by the reactivations and optimizations that are part of this capital deployment. As Shubham mentioned, there is no drilling risk. Capital is deployed into known reservoirs and known wells. Production additions ramp through the year as this capital is deployed. And effectively, as we already heard, the program delivers approximately 250 barrels a day of incremental oil. Key message here being that growth is repeatable, controllable, and execution driven. And this obviously the base production and the added production get us the total, which as you can see increases sequentially through the year, combining stable base production and layered incremental volumes. An exit rate production materially higher than starting point, exit rate between 1,100 and 1,200 barrels a day. This, of course, supports higher cash flow, stronger netbacks, and operating leverage. And the focus of the message here being that production growth is structural, not cyclical. Capital expenditure discipline. So now the infrastructure is in place and high return workovers and reactivations. The $2 million of funds going in is focused on growth CapEx tied directly to production uplift. Capital is deployed earlier in the year rather than later to accelerate cash flow realization. And there's no capital allocated to speculative drilling or longer cycle projects. This is essentially when we spend money in 1 month, we expect to see production online in the month following. As we've seen with some of these loose land wells, we actually see production continue to increase as the well is optimized and production with sand comes. But in summary, every dollar of CapEx is actually tied to near-term production and cash flow. Capital efficiency and payback, I think it's about 8,000 per flowing barrel of incremental production. So that's a sub 1 year payback at the field level. And this capital intensity is materially below acquisition metrics. So highly efficient capital included in this growth plan. Overall, this growth plan lowers risk, layers risk, low risk reactivations on top of stable base using disciplined capital that converts quickly into barrels of cash flow. The field cash flow piece here. So this slide here effectively demonstrate the field cash flow being generated. These are numbers that are going to be before G&A, before interest. You can see the top in total dollars on the table. The bottom section is effectively dollars per on a dollars per BOE basis. And breaking that down, we're about 95% liquids rather than gas, and so really the majority of these are barrels. But we see in the table that field cash flow increases sequentially quarter over quarter through the quarter, or through the year, sorry. Growth is driven primarily by incremental production from these reactivation workovers programs. Stable operating cost structure. Q2 and Q3 reflect the full impact of the deployed capital, with Q4 showing a run rate normalization. The key message here being the cash flow growth is operationally driven and not price dependent. The impact of the incremental production, adding 250 barrels a day of oil, converts directly to cash flow quickly, leverages existing infrastructure, and minimal incremental fixed operating costs. So we're not seeing additional property taxes or surface lease rentals, or even a drastic increase in operators. We're seeing largely dollars increase because of variable operating costs like chemicals and trucking and other variable related items. But effectively, the $2.5 million increase in field cash flow, which is a 43% increase from a baseline scenario without the deployment of this capital. So you can see how the high operating leverage on low risk barrels really starts to improve the business overall. Field netbacks remain strong and consistent across the quarters. The netbacks benefit from high oil weighting I mentioned earlier, fixed operating costs spread over a higher number of barrels, and then optimized lifting and transportation costs. We're able to achieve additional efficiencies on these items with more barrels in place. And it also opens up improvements to pricing. We can ship to additional locations with more critical mass, essentially. But margin quality is essentially preserved as the volumes grow. The operating leverage is the majority. I mentioned this is based on fixed or semi-fixed. Incremental barrels flow through at higher contribution margins through the plan. With scale, profitability improves, but the complexity doesn't. Yeah, I think overall here, the key takeaway is that the reactivation program converts directly into durable field cash flow with strong netbacks and minimal incremental cost growth that strengthens both the balance sheet and the equity value. Shabam, I think the next one here is free funds flow. So yes, field operating cash flow is important, but we have to look at the bigger picture. We have to look at how the G&A and the interest are being taken into consideration, and then offset against CapEx, so that we can essentially balance the business overall. And 2026 kind of marks it does mark the transition from break even in 2025 to sustainably positive free funds flow. And you can see about $1.2 million of positive free funds flow being generated 2026. 2026 generates incremental free funds flow, but this growth capital converts directly into cash generation, and allows the company to actually redeploy a lot of these funds to further growth or debt management. The free funds flow retained on the balance sheet through 2026, it it improves sequentially as production stabilizes, as you can see. And the business begins effectively to self-fund on the back end of this, which means that additional equity isn't required to sustain growth, but perhaps as a further accelerant. Net debt reduction is a big, important component for this business. You can see the positive free funds flow enables consistent net reduction through the year. Net debt peaks early in 2026 and then declines through the year end. So improving debt metrics, enhanced covenant headroom, refinancing optionality, equity value per share, et cetera, et cetera. And the capital shifts essentially from survival mode to balance sheet repairs, and allows us to get a line of sight on paying off full, the full amount of debt that's outstanding, which was over leveraged as we were inherited this business in October 2024. Capital discipline and use of cash. So priority of free funds flow means we can maintain operational liquidity, reduce net debt, which was been mentioned, and then reinvest into reactivation and additional workovers. Cash flow allocation is deliberate and disciplined, and we can be more planful about this than reactive. So overall, the key takeaway is that this program fundamentally changes Prospera's cash flow profile. It establishes a path to reduce debt with internally generated funds, which is where this company needs to be as we plan forward. The next slide is investor returns. So this slide is the potential of the outcome for on the backside of this private placement and the 2026 development plan. It illustrates it's intended to illustrate the equity return resilience across commodity price environments. So it demonstrates how incremental production and cash flow translate into per share value. And the highlights operating leverage without balance sheet stress. So there's two scenarios that we've got included here, and one is really a baseline scenario at $60 WTI. The second is more of a blue sky scenario at $80 Q2 going forward. The $60 WTI case assumes the same production growth that we've seen on the previous slides, 11 to 1,200 BOE by the end of the year. The enterprise value expands through volume growth, not pricing assumptions, and net debt declines modestly as free funds flow start to turn positive. We see share price increasing as a result of these numbers from currently about 3.5 to 4 cents to 5+ cents by year end 2026. The investor takeaway here is that equity value still increases materially in a low price environment. Cash flow remains sufficient to support operations and deleveraging, demonstrates downside protection of the reactivation workover model, and even at $60 WTI, the strategy works. The $80 WTI scenario is essentially the same model, but with the same production, but that the upside is driven purely by pricing leverage. Enterprise value expands meaningfully on higher cash flow multiples. Net debt reduction accelerates as free fund flow increases, with higher potential for higher share price by year end 2026. The investor takeaway here is that significant torque to oil prices once production is scaled. Equity holders capture disproportionate upside in the high scenario, and that balance sheet strength improves faster, increasing strategic optionality. And the key message here, operational execution plus price leverage results in outsized equity returns. And you can see the key takeaway on the slide that at $60 WTI, the equity works. At 80, it works exceptionally, and that in both cases, value creation is driven through execution, not speculation. These are the 4 slides that we had on the financial piece here, and just would really kind of like to drive home the conclusion, the presentation. Thank you for all attending. This is what's expected to be now a monthly conference call, and that we'll be hosting, and all the folks that are on this call can expect some follow-up information from us. But in conclusion, you're aware of the $3 million non-brokered equity offering. That's currently open until February 15th. We are currently sourcing funding for that program. You can see the 26 plan here is a very focused, high return use of those funds. It's low risk, it's execution driven, and there's significant growth and meaningful production that's achieved from this plan. And essentially is a step change in cash flow with a clear path to self-funded growth. So one of the key components to this is that there is equity dilution involved in this, and we needed to look at this closely and have a proper rationale and value proposition to be able to put this forward. And our position is that at a low capital intensity at 8,000 per flowing barrel, we're accepting approximately an 18% dilution, which generates a 43% increase in field cash flow with a sub 1 year payback. These are metrics that compare extremely favorably to our peers, which are acquiring production at a much higher multiple with additional risk. So that being said, Shubham, why don't I pass it back to you just for the wrap up, and then Sean, if you've got any questions that are coming in, we'd be happy to take anything going forward.
Yeah, you bet. Thanks, Chris, for that financial update there. And, alongside the operational update and where things are going, the strategy from an engineering and operations standpoint has been proven out. We've built resilience all the way down to the $60 WTI, where we can hunker down and stay here flat while some of our loose land wells continue to perform, add barrels throughout the year, while we have the Cuthbert Pipeline project continue to add waterflood barrels. However, given the exceptional performance we've had, the ability to add reliable, stable barrels at a very, very capital efficient manner, we believe that we are in a position where this equity placement makes a lot of sense and allows us to accelerate some of that growth. If WTI drags down further, we can act very, very quickly. We're not signing up to long, big drilling programs. We're not signing up to projects where capital goes in and then takes months for it to come online. We can get these reactivations done in a period of 2 days. So if we decide, hey, we want to do it tomorrow, you get the rig on there. We've pre-planned for all these reactivations. Field operations knows, the vendors know that this is our sort of rough plan. We can decide, and within 2 days, the well is online. It produces load fluid for 4, 5, 6 days, and then bam, it starts producing positive operating cash flow. So the strategy has been proven out. We've got exceptional tier 1 reactivation still on deck, and we would love to partner up with strategic investors who want to come in, build with our strong technical team, our strong financial team, and our board of entrepreneurs who collectively own about 45% of the stock and are heavily invested in the name. Ourselves, we are diluting ourselves at the end of the day, but for a greater cause, 6, 12, 24 months down the road, and further proof and proving out of the strategy. My email is here on the slide here. So is Chris's. We are available for general questions through email. We're happy to set up one-on-one calls with interested and strategic investors. Chris can walk through the financials and the budget in a bit more detail. I can nerd out over the wells for as long as required. I think this has been something I identified when I was operating wells myself in the field, Weyburn, Provost, Elk Point, seeing the inefficiencies in some of these wells, seeing very, very high quality wells left untouched because the companies just didn't have the focus to go after these 7 to 30 barrel per day producers. Well, we've come in and we've proven it works. We're transparent about it. We got the information out there, and I'm looking forward to partnering up with other individuals and stakeholders and investors that want to grow with us. So our emails are here. I'm also available on Twitter at White Tundra SG, as well as through email on the Prospera end here. And with that, I appreciate everybody's time here listening into our detailed discussion here today. This will be posted on YouTube as well as the Twitter Space audio recording. We will also have the calendar up for the future conference calls up on the website, so that investors can tune into this and sign up in advance of this. And with that, I'll pass it over, Sean, if you have any questions that have come up through either the Twitter or the Zoom session.
Yeah, thanks, Shabam. Yeah, a couple of questions came in. This came in a little early, so we may have touched on it, but I'll share it anyway. Can you address the company's ability to fund operations and improvements through the current weak pricing environment to expect better pricing by year end? Again, that may have been touched on, but I'll pass it to you guys.
Yeah, I can start with that, and then Chris, if you have any follow-up thoughts there. The company has shown resilience all the way down to $57 WTI. We feel that we have the right cash flow profile. We have the right reliability work already done. We haven't had any major incidents, knock knock, in a while now. We've got enough cash on the balance sheet. We've got enough support through our existing investor base to proceed here and be able to run through a $57 to $60 oil environment, hold steady. As mentioned, the barrels are coming up without us spending any capital. This is very, very different to most oil companies, which suffer from declining production if they don't put any money into the ground. So, as shown through the 6 wells, investors can see additional wells through our key wells report that's on the website of examples of how these wells are rising throughout time. We expect to see that cash flow continue to increase along with operating costs decrease if we just hunker down. We've got two different types of budgets for the corporation. One's a absolutely zero capital spend budget, exiting the year with about 5% growth, and then one is this acceleration budget with capital spend, as was shown here through the presentation. So we've got the ability to sit tight. As that WTI price rises, it allows us to self-fund some of these projects. Now, that's not going to happen the day that oil hits X number and bam, we're out there with the rigs drilling away or anything. It's not going to be like that. It's a very sustained, it's a very carefully designed program. What it does allow us to do is do small jobs. Because our jobs range from 27K for a workover to 150,000 for a full new reactivation, we're able to move quickly and do small jobs as need be. We don't need to wait for many months of cash flow to go and do a simple job or one drill or anything like that. Allows us to be very nimble. Of course, lower oil pricing has allowed us to get better relationships with our service providers, build strategic relationships with them to work on 1 or 2 well programs as that rig is driving through site to a different ENP, or whatever the case may be. So we're confident in $60 oil. We can scale as prices rise. At the same time, we think that the projects we have on deck here with a sub 1 year payback and then continued payback over the 20 to 40 year lifespan is something that is worth accelerating at this point in time with the right capital partner and the right availability of capital on the balance sheet to go ahead with this program. Chris, please go ahead.
Thanks, Shabam. And I would echo that as well. I think that what we've shown in the modeling here as well is that at $60 WTI, we're still actually seeing fairly positive netbacks on the Canadian dollar side. There is a heavy to light differential that we deal with. There is a U.S. Canadian exchange rate that we're seeing as well. But even at those dollar amounts, we're seeing a $65 Canadian barrel. And with operating costs being reduced into the kind of the high 20s, low 30s, you could see that there's still positive field cash flow that's being generated in the material. We were seeing the $20, $24 kind of through the year in terms of field level netbacks. So $60 WTI with our reactivation economics still delivers sub 1 year paybacks, positive free funds flow, and sufficient cash to reinvest internally. This will let us grow production without relying on external equity. And I kind of bring it back to the fact that we're able to execute these. These are smaller projects, all sub 10,000 per flowing barrel. But as Shabam mentioned earlier on, these cost anywhere from some 60,000 up to 150,000, depending whether it's a workover or reactivation and some of the surface equipment requirements. But that is significantly lower than a lot of others in the industry or our peers are showing, and it allows us to scale up or down very quickly as well. We can turn these programs up or down, really depending on where WTI is trading at that week and where we're projecting cash flow to be. So I think with a small company, we're actually quite nimble in terms of our flexibility and ability to adapt to various different pricing environments. We do also have some hedging in place as well. Not a huge portion of our barrels online, but some of the Cuthbert barrels are hedged actually at $67 WTI per barrel. So that allows us a little bit of consistent outlook just in terms of what our capital program looks like as well.
Another macro question here. Given there's a lot of talk about Venezuela going to flood the USA with heavy oil, what are your thoughts on the macro setup on that issue?
Yeah, thanks, John. I think we're seeing consistent strength in WTI here. There's been a lot of further barrels released by OPEC. There's been the Venezuela issue, adding further barrels, and we're not really seeing inventories increase. We had a big flood of oil on water. For those that follow my Twitter profile, you're seeing some of the graphs roll in, but you're not seeing that increase in global onshore crude. You're not really seeing the increase in the OECD countries' onshore crude. So it's something we're monitoring quite closely. We're monitoring our hedging strategies, as Chris mentioned here, to ensure we protect the downside. We need to be very, very nimble here in terms of our capital spend. And I think we just need to monitor the situation. There's not going to be barrels added tomorrow. This situation is going to take some time to develop. At the same time, this is a paper market run commodity at the end of the day in a lot of ways. So we have to be careful of the messaging being sent out by governments, with the messaging being sent out by E&Ps. But at the end of the day, you're seeing OPEC adding a large amount of barrels that hasn't really materially resulted in oversupply, while the U.S. shale companies are already cracking. The Texas Midland production was down in 2025 year over year. The Eagle Ford production, the Bakken production was down year over year. You really only saw increases in the GOM and in the Delaware Basin. So as that starts to now flatline and drop, you've got sort of two competing forces here. And we think we have the business model and the asset base to continue increasing barrels, prove out our strategy, and then get to the other side, entering the bull cycle with a war chest of strategies that are proven out, with amazing wells that continue to pay back month after month after month, and then with optionality on increasing into a polymer flood or additional reactivations or acquisitions of other suspended pools in the area, which are completely non-core to our peers. And we can go in and run the same loose land strategy on those pools. So the idea of the corporation is simply to execute every day, continue providing value, continue adding barrels, continue proving out our strategies, hedge where required. But at the end of the day, we're in this business because we see a long and strong oil bull cycle here ahead of us, backed by OPEC releasing spare capacity, but staying cohesive, inventory staying flat, global demand rising at a massive, rapid rate, and then the U.S. shale production starting to slowly deplete over time, especially at these commodity prices.
Next question. This is a little bit forward-looking, but maybe you guys want to touch on it. Thanks for the presentation. Where do you see this company in 5 years from now in terms of production volume?
Yeah, I think the goal of the company is to continue to execute every day and every month. This is our 2026 plan that was mentioned today, which is the first forward-looking type of plan we've mentioned over the last 14 months. We are not big believers in going out and putting out 5-year plans. Conceptually, the plan is simple. We've identified a mispriced opportunity in the market, which is reactivation of wells that have been dormant for many, many, many years. We've proven out that strategy over the last 14 months on 18 wells. We have 140 wells in-house to go. And we're just going to continue operating the company as an owner would, with 45% of the shares owned by the board. We are invested with our blood, sweat, tears, money, cash, whatever you want to call it. And we're not doing this for the sake of a paycheck. We're not doing this to grow the company, to become an empire builder. We're doing this because we're in it, and we're in it to win it. So you'll continue to see updates every month that will drive the corporate strategy over the next 3, 6, 12, 24 months. And we'll just continue to put the hard work in, and execute. If I sit here and say I want to do this in 5 years, that can change materially based on what happens over the next month in terms of commodity price, in terms of the wells, in terms of capital availability. So I really appreciate the question. I think you're asking the right question. But Prospera is I think going to be unwilling to provide an answer to this question. We'd rather show you what we've completed and what our more near-term plan is, and we'll just continue to execute. And next month you will expect to see another update from us as to how that's gone, and then that just plays into the general growth and sort of business strategy of the corporation. Chris, any thoughts?
Yeah, absolutely. I mean, I think that, the direction of the company here is dependent on the reserves that the company sits on. The three core assets will allow for significant reserve life, significant amount of organic development over time through reactivations, workovers, and then perhaps even further down the road, infill drilling, if we decide to go down that road. But there's so much reserves that the company is sitting on with existing infrastructure that was developed by majors like Nexen and Strathcona. I mean, these facilities were built for much higher volumes, and so I say the potential's there. We've got the equipment and infrastructure in place to be able to go to much higher level of production, and I'm happy to have this conversation offline further.
Just looks like two more here, guys. These wells seem to be going up. What do you think they can get to if you use one of the examples you talked about today?
Yeah, I think I'd like to tell you what I really think, but at the end of the day, we've had wells that were at 5, 6, 7 barrels for months. We got them now up to 32 barrels a day. We're monitoring the reservoir. We're learning every single day from the data collection. We're learning every single day from what we see out in the field, and we're adapting accordingly. I think, when you go back to these reservoirs, some of these wells used to make 350 barrels a day for months and years on end, steady production at low water cuts. Am I saying that's going to return on those wells? No, but we've now got to 10% of that rate on one well. We've got to about 7% of the rate on 4 wells, and so we continue to just push these wells harder. And what's really exciting is on the other side of the loose land main pool in that section 33, which we've been talking about, those wells never produced at those rates. So it's got the same log character, if it's got the same type of reservoir, if it's got the same oil viscosity and API, there's some interesting forward-looking sort of conceptualizations you can start to do on what those wells can make. We think that we'll have wells that produce 20, 30, 40% of the previous peak highs as we continue to produce them effectively. We're seeing wormhole propagation, where the oil turns from a black, viscous, dead oil to a more brown, foamy oil about 6 months after reactivation. That's the solution gas drive. That's showing you your wormholes propagating into areas where it hadn't gone to in the past. So very exciting. What I'm going to try to do to really answer this question properly is maybe on the February or March operations update, we'll start with a 15, 20, 30-minute presentation on the reservoir itself and some of these production engineering and technical wins that we're seeing, and then provide some baseline. And by then, some of the wells are going to continue to rise, and there might be some further information to share. So we're very excited about the pool in terms of sort of a raw numbers. A well at about 30 barrels a day will pay back every 2 to 3 months. So you can kind of see how that begins to escalate quite rapidly as we continue to grow the company. It's required a lot of patience. I will be honest. Some days I think, why not another 5 RPM? Well, why not? Let's see what can happen. And that's just not the strategy. So I slap myself and I say, no, we're not doing this. We're going to produce the well consistently, stably, with discipline. We don't want the well standing in, and we'll continue to show this result as 2026 continues. I am exceptionally interested to just press a fast forward button and see what happens. But it's not the way the real world works. So we'll continue to put in the effort every day. We'll keep putting out graphs to investors through the Key Wells report and through the ops updates. And for investors that want to dive a bit deeper into it, just wait 30 to 60 days for our next conference call, and we'll dive a bit more deeper into it. I'm also available one-on-one if you'd like to chat, kind of share a bit more about where I really think some of these wells can go as they're starting to produce. But history tells us something, and so does what we've accomplished over the last 14 months in terms of continually adding barrels thus far.
Thanks, guys. Another question. What are the benefits of being able to sell loose land barrels directly to asphalt companies?
I can take that one, Shabam. The loose land crude is a specific API. It's a 11 to 12 degree API crude, which is exactly what the asphalt companies in Saskatchewan look for. So when they're out paving the highway or doing asphalt work, this is the type of crude that they're looking for. And so we've been able to set up a relationship with a significant paver, and they also make roofing tiles, I believe. And what that means for Prospera is that we've been able to actually improve our netback over the summer months by about $5 a barrel from a pricing standpoint. And we also receive a secondary benefit due to the fact that the asphalt company comes directly to our facility and picks up the crude on their trucks. And so we end up with about a swing of about $10 a barrel on the loose land crude. And so this is a really attractive contract for us. And you may have noticed in some of the information that was presented on the field cash flow that the pricing increases through the summer. And so that's actually the driver behind those netback improvements. And so we look forward to further penetrating that business and expanding it this year with the additional loose land volumes that are online. We look forward to selling more through those asphalt contracts. Shabbat.
Yeah, no, I think you hit the nail on the head. We are a very creative team here that is really pushing the boundaries in terms of the sales, the revenue maximization, looking at the different kinds of deal structures, creative financing, working with our landowners, working with the MER on some of the discussions there. We meet with them very regularly. Adjacent to a lot of oil companies that'll tell you they're scared of the regulator. We work with them. We understand how we can be aligned and work together. And part of that is this asphalt contract. So just one of many ways that we continue to add value to the corporation. We've got much more efficient as an organization, even though we've reduced our G&A massively. We've consolidated software costs. We've been able to make some really interesting deals around the software. And our social media presence is some of the best in the business. So both through Twitter, the LinkedIn micro content, investors can expect to see absolutely ruthless focus on transparency. And we'll be reporting some of these wins here through the ops updates. We'll be sharing some of them through this monthly conference call format. And I think just in general, the ability of the team to add value increases every single day. Part of that, of course, is this asphalt contract that increases our netback significantly in loose land, which is our highest growth area. So as we continue to add barrels here, the overall pricing of the company is affected in a bigger way because the loose land barrels end up becoming a larger portion of our total sales. And we're looking at various other things we can do on the trucking side, on the sales point side, on the blending side, ways to add value to the corporation, and that will continue nonstop. This is a massive business. it's not simply oil comes out and it gets sold and then it's a gas at the pump. There are so many places along that value chain that we can take over that value as an oil producer. And yeah, I'm excited to share more of that here through this format as the year continues.
I think we'll do maybe one more. I see a bunch more questions coming in. We are going a little long. I'll remind everyone, all three of our emails are on the press release. So if you do want to reach out directly, please feel free. Please comment on the team aspect of the corporation. You have decreased CapEx, but has that been at the cost of efficiency?
Yeah, you bet. So that's what I referenced here in the last answer is we've been able to add efficiency to the organization while reducing G&A. We built a team here of young leaders, people that are taking accountability for their actions. Chris, myself, and our senior team is always available for soundboarding, talking about ideas, brainstorming, coming up with decisions. But at the end of the day, each employee is not only wearing many hats, but they are the subject matter expert on those hats. So unless we see a problem from the top end on something that's a glaring error, people have been given the ability to proceed, make decisions, hold meetings, come up to engineering learnings, present those as they need to, and just an exceptional overall team building. I'm very proud of our production growth. I'm very proud of our strategy proving out. That's obviously at the baseline of the company, but I'm also proud of having built here individuals and leaders that can carry this team forward over the next 1, 2, 3, 5, 7, 10 years, and really build a strong business out of it. I remind investors and people on the call, we're not in this as employees. We're in this as large stakeholders and large ownership of the corporation, of the debt instruments, of the equity. So we see this as building a business that we are running, not something that is maximized for G&A burden or whatever. So really looking forward to see that continue. And yeah, just see that grow. And I see a question here on the growing production. So we did have a very ambitious growth plan in 2025 that was backed about at a $73-$74 WTI budget. So with WTI being well below that, severely affecting our cash flow, we expect that the growth rates will be a bit more moderated on a month-to-month basis. That being said, if we find the right strategic partner and as investors come and participate in this equity offering, we can not only accelerate that growth rate upfront, but then that higher base barrels allows us to get back on a meaningful growth rate on a month-to-month basis. Sort of, the way to think about it is 850 barrels at 72 WTI generates the same cash flow as 1,100 barrels at 60 WTI. That's sort of not the exact numbers, but generally, conceptually speaking, gets us back into that same corporate cash flow generation per month, which allows us to proceed. Proceed backed by really, really strong dedication to the cause. We've got daily fluid shots. We've got daily wellhead cuts on some wells. We've got strong monitoring on these wells. We've got operators at the wells multiple times a day. In certain cases, our field operators are shareholders of the corporation. We run our own pressure trucks and steamers and snow plows through those field operators. We're all invested into the cause. So we've got strong analysis. We've got strong measurement techniques that we're using on that end. And we continuously have multiple engineers that track the wells on a daily basis. We have well-by-well reviews, comprehensive every 2 weeks. Myself or our Chief Operating Officer, Darren, kind of stagger our trips to the field, but somebody's out there every 3 weeks, not to be big boss out there, but to work with field operations, understand some of the knickknacks that don't necessarily make it out through meetings or through the field reporting software, and really work with the team there. And many members of our team have operated wells in the field before, who are now in the Calgary office. So, you can never be bulletproof and say, I am God himself and the well will never go down. But you can do a damn good job at it and really track the wells, very, very closely and make adjustments as you go. If you do have a failure or a near miss of some sort in terms of the well going down or sanding in, you adapt your strategy across all wells going forward. That's, it may apply to business, but that's simply how life is, really. At the end of the day, people that are successful will adapt, take what the world gives them in terms of learnings and data, and apply them to the future as we build our business.
Okay, I think that's it on the question side. So yeah, unless Shabam or Chris, you guys want to close, I think that's pretty much wraps it up for today. So I want to thank everyone for taking the time and appreciate you joining us.
Yep. Thank you, everyone. As mentioned, our emails were as part of this recording. They're also posted on Twitter there underneath the Prospera account on the comment. Investors that want to discuss further are welcome to contact us. We're also available at 7th Avenue here in Calgary. Investors that want to join us in person. A reminder that our offices are set up in a museum type of fashion. So as you enter, the walls have been set up to show the technical learnings, some of the successes and the wins, our pool information, and just general overall characteristics. I see there's a question asked about how do you know that this is going to work? We're happy to walk you through that through our little mini museum and then chat in detail as well. So I welcome any investors and stakeholders that are interested, and we look forward to meeting here again in about 30 days on the February 2026 conference call. Thank you kindly.